Airlines move more than 4 billion people every year. They connect the entire planet, and they generate hundreds of billions of dollars. And yet, for most of aviation history, airlines have been terrible businesses. In fact, investors have lost tens of billions of dollars in this industry. That's why legendary investor Warren Buffett once said something shocking. If a far-sighted capitalist had been present at the first flight in 1903, he should have shot Orville right. Why would the greatest investor in history say something like that? Because the airline industry reveals one brutal truth about capitalism. Not every great product creates a great business. The airline industry suffers from a very specific economic structure, and that structure makes it incredibly difficult to make money. Running an airline requires enormous amounts of capital: aircraft, infrastructure, maintenance, and constant upgrades. At the same time, airlines face brutal competition. Customers can compare ticket prices in seconds, and they almost always choose the cheapest option. As a result, airline profits are extremely volatile, and over long periods of time, many airlines barely make money at all. The first problem with airlines is capital. Running an airline is incredibly expensive. Aircraft alone can cost tens or even hundreds of millions of dollars, and buying the plane is just the beginning. Airlines must constantly spend money on maintenance, training, fuel, and airport operations. Even worse, these assets are extremely fragile. If demand falls, planes still need to be maintained. If fuel prices rise, costs explode. Over time, this creates a brutal financial cycle. Airlines spend enormous capital just to stay in the game, but the returns are often disappointing. But capital intensity is only part of the problem. The real problem with airlines is competition. Air travel is one of the most competitive industries in the world. To most customers, one airline seat is almost identical to another. A flight from New York to Los Angeles is still the same journey no matter which airline you choose. Because of this, airlines compete primarily on price, and price competition is incredibly destructive. When companies constantly undercut each other, profits disappear. This is exactly the dynamic we explored in the previous episode. Competition destroys profits, and airlines suffer from one more problem. A problem even worse than capital and worse than competition. They have almost no economic moat. The most powerful businesses in the world share one common trait. They have something that protects their profits from competition. Warren Buffett calls this an economic moat. For example, companies with powerful brands can charge higher prices. Customers willingly pay more because they trust the brand. Some companies benefit from powerful network effects. The more people use the network, the stronger it becomes. But airlines have none of these advantages. To most customers, one airline seat is nearly identical to another. When customers choose a flight, they rarely ask, which airline is better? They ask a much simpler question: which ticket is cheaper? And when companies compete primarily on price, the outcome is predictable. Margins collapse. Profits disappear. This is why Warren Buffett avoided airline stocks for decades. He once joked that investors should have shot down the Wright brothers to save capitalism. For decades, Warren Buffett refused to invest in airlines. He believed the industry had a fundamentally broken economic structure, too much capital, too much competition, and almost no durable advantage. Buffett once joked that if a capitalist had been present at Kitty Hawk in 1903, he should have shot down the Wright brothers because the airline industry has destroyed enormous amounts of capital. And yet, in 2016, something surprising happened. Berkshire Hathaway began buying airline stocks. At the time, the industry looked different. After years of bankruptcies and mergers, the airline market had consolidated. Fewer competitors, better pricing discipline, higher profits. But in 2020, the global airline industry faced an unprecedented shock. The COVID-19 pandemic stopped global travel almost overnight, and Buffett made a decisive move. He sold every airline stock, completely exiting the industry. The lesson was not about timing, it was about economics. Even the best management cannot fix a structurally weak industry. This is why great investors spend more time studying industries than studying companies. In capitalism, competition is everywhere, but the best businesses find ways to escape it. Next episode, pricing power.